And a big welcome to our live audience for Digital Health Investor Talk. I'm your host, Steven Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me on x.com/Steven Wardell. Our show today is on the topic, A New Birth of Consumers Are Increasingly Spending Their Own Dollars and Becoming the Decision Makers in Healthcare. Our guests today are Jared Bressner and Todd Pietri. Jared and Todd are partners at Activate Venture Partners, an early-stage healthcare technology venture fund where they have made a number of consumer-themed digital health investments. This show is being recorded and will be included in my podcast series called Digital Health Investor Talk. Subscribe to our podcast on Apple and Spotify and leave us a review. We always love getting 5-star reviews. We have a new podcast link for the show, so make sure that you see recent episodes when you subscribe, or you'll be subscribing to the old link for the show. This is not investment advice, and we are not investment advisors. Here's the format for today's show. It's 90 minutes long, and my friends here and I will spend the first half discussing the news and the macro picture and some other topics, and then we'll focus on our special topic of the day in the second half. And we'll be taking your questions throughout the show in the chat. So welcome, Todd and Jared. Please introduce yourselves.
Thank you. Steven, I really appreciate you making this possible. I appreciate the work you do. I'll tell you a brief anecdote in a second. My name is Todd Pietri, co-founder, general partner of Activate Venture Partners. We have offices in Bethlehem, Pennsylvania, and New York City, which is where I am right now and where I live on the Upper East Side. We're in Midtown now. We invest, first institutional investor in early stage software, data, and services companies in a bunch of different verticals. However, healthcare is the most prominent. About 60% of our capital flows into digital health businesses. We're typically writing a $2 to $3 million check in rounds where we're more than 50% of the round, and we price it. It's preferred stock, and we prefer them to be close by, and we try to help be a productive partner. Just quickly on the anecdote, Steven, you took me around HIMSS ages ago, and you introduced me to all these different cool companies, and I just liked the way you did it. It was fun. It was educational. I met a bunch of people, and ever since I've admired your work and have been listening to your podcast routinely.
Great, thank you. Yeah, that's the HIMSS booth tour, and I'm sort of evaluating whether to do a health booth tour in October or something like that. But thank you for that.
Definitely do it. I think it's an absolute winner.
I'll join it. Well, I want to echo Todd's appreciation for having us join. Steve, I was speaking with somebody the other day, and I have to admit I recycled something that you oftentimes say, which is, we call it digital health today, but in the future, I think we're going to drop the term digital because it's going to be sort of the status quo in healthcare eventually. My background is actually in clinical medicine. I'm a physician by background, an orthopedic surgeon, and I spent about a decade and a half of my life at Hopkins before migrating out. I did my medical training there too. And in addition to taking care of patients in the operating room, I built a biomedical engineering lab where we developed a fair amount of intellectual property and joint replacement implants. And I also designed some surgical instruments with industry companies, and it really gravitated towards the technology side of healthcare, where when we do things right, we can affect orders of magnitude more patients than I could ever hope to achieve in the most ambitious surgical career I could endeavor. A different touch point with patients, but really the sort of scale that we can achieve on the venture side through healthcare technology is really resonating with me. So I'm fortunate to be here with you today and representing Activate.
Worth noting, Steven, that Jared is the son of my counterpart, co-founder, and also managing partner, Glenn Bressner. And Jared had interned with us while he was a very busy resident. He squeezed 3 or 4 weeks in with us. And we were so blown away that when we launched our next fund, which we've had a first closing on, we're making investments out of it, we decided we wanted to add clinical expertise because we've been investing in digital health a long time. We've made invested in 37 different businesses. And we wanted to have the clinical angle, even though we don't invest in therapeutics, diagnostics, or devices. It's mainly software, data, and services. but it still will help us and is helping us a great deal. So we're thrilled to have Jared.
Appreciate that.
Great, thank you. Yeah, Jared. So the analogy I use is that a few years ago we used to say my smartphone, and before that we said my mobile phone, and then today we're saying my phone. And a lot of people don't have landline phones anymore. And so likewise, digital health meant something 5 years ago. It means something today, but eventually it's going to be healthcare. And all healthcare is going to incorporate software and data and AI and other technology. Also, jumping into macro news, and the summer's slow for macro news, but I see that the NASDAQ is down today. Some turmoil here, fell 2.5% today. And CNBC is calling it a rotation out of tech stocks. And the NASDAQ is really heavily driven by the 7 biggest tech stocks on a weighting basis. So in general, we like a high NASDAQ. We like all high stock indices because it allows innovative digital health companies to exit into a high valuation stock market. And so I guess I'm going to call this a bump in the road and not something to be worried about. I don't see a major pull-in of the NASDAQ that would be concerning. Todd, Jared, do you guys follow macro news and tech indices and that sort of thing? And what do you think of today's 2.5% pull-in?
We follow it. I follow it, but I don't. It doesn't change what I do much because I don't pretend to be able to predict it. And we are building companies over a long period of time. So it clearly affects, liquidity, distributions, capital raising, but it's not something that I pay a lot of attention to. Jared?
Yeah, I echo that. I read an article this morning that posited that this is a lot driven by the semiconductor industry, worried about essentially the administration putting penalties on businesses companies doing business in China, perhaps representing some of that sentiment causing the rotation. But again, I'm not a super intense follower of the macro news either. More so, I definitely still have my head buried deep in healthcare news, and obviously, coming from orthopedics, a lot of that trickles over.
Thanks. And somewhat surprisingly, I would call the IPO window closed right now. Now, closed doesn't mean no IPOs. It just means that you don't have regular IPOs. You can't predict whether a company could IPO. There's many companies in digital health that would like to IPO, but we've actually had 2 health tech or digital health IPOs. So one of them is Waystar. The other one is Tempus AI. These are in the last couple of months. The ideal setup, what digital health, we would like the IPO window to open. There's a chance it will open in the fall. That would be great news for the innovation economy if it opened in the fall. And what the setup I think is necessary is you need to have a huge successful IPO of a tech or biotech company. So the ultimate example would be if Starlink went public, for example, or if it was carved out, I think it's part of SpaceX, and fundamentally it goes public and then the stock price afterwards goes up. If that happens, then suddenly it creates a FOMO environment on Wall Street, and then you'll have more tech and you'll have biotech companies will seek, or healthcare services companies will seek to go public. And if some of those go public and their stock price goes up, there's usually an IPO discount built in of 15%, so they expect the stock price to go up 15% and stay up. Then after that, and this could all happen in September, October, November, then you'll see many digital health unicorns will line up to go public. But there'll have to be a delay because first they see it, and then the board makes a decision, tells the management to try to go public. And we'd like to get those digital health companies public. We'd like to have the investors harvest returns, put that money back in the earlier stages of the innovation economy. And so we don't have that playing out right now, unfortunately, but buy-side investors have high demand for IPO product. They have money. They want to put it to work in this way. They're just concerned that the IPOs won't do well in the aftermarket, and and so there have been multiple attempts since, call it March, to open up the IPO window with some IPOs. None as glamorous as a Starlink IPO, but nevertheless the window remains closed. That's somewhat odd for the NASDAQ being at all-time highs and then to have the IPO window be closed. And this seems to be partly related to the fact that the NASDAQ at all-time highs is really just the top 7 stocks. outperforming on an AI story basis, perhaps. So Waystar went public a few weeks ago and has stayed largely flat. Waystar is a revenue cycle management company. It went public because its private equity backers needed to harvest a return to their LPs, and so they've largely stayed flat since then. So, and I would have liked to have seen them go up 15%, but at least they did not perform poorly in the aftermarket. So Todd, Jared, any thoughts on the Waystar IPO?
Well, I think in some ways it's very encouraging news because price stability, I think, is a net positive. But I think maybe a sort of marker of a trend, or maybe even a little bit of a struggle in the digital health sector in general right now, or the public companies in digital health, is that at least as my last reading, it was generating about $800 million a year in revenue, but still was not a profitable endeavor. I think it was about $50 million. And I think this is a struggle that's really prevalent in the public digital health sector right now. So I think I'd consider still the price stability to be a net positive, but I'm hoping that we'll see some markers of some of these big companies achieve profitability and sustain it as a sort of sign of turning tides.
I'm only interested in that IPO, and I'm glad that it happened. I'm happy for them. But we do believe that some of the clinical analytics companies can add value to revenue cycle and vice versa. So revenue cycle companies have historically not added a lot of value on the clinical side. So having liquidity there is a good thing to happen. I want to learn more about what their acquisition plans might be, because now they have a currency. More than anything, I need to study up on it.
Yeah, Jared, so if a digital health company that's public is earnings negative, what investors want to see, usually it would be growth investors who would be investing in that, and what they would want to see is that there's a plan that, first of all, if it's a growth company that's earnings negative, that's okay. It needs to be growing fast. Right. And I would call it needs to be growing at over 20% top line a year. And if it's small, it needs to be growing at over 30% top line a year. And that's part of the story of why they can be earnings negative. But then usually they also need a plan within maximum 3 years, ideally less than 2 years, to become break even. And when it starts to be a bad thing is when it's not growing that fast, or alternately, they can't show a plan to becoming break even in 3 years, or it just has taken them a really long. Or one other element of this is a promise of high margins at maturity, which you don't always see high margins at maturity in an earlier stage company. And so if any part of this starts to fall apart, like it just takes them too long, or people don't think they're going to have high margins at maturity anymore, or whatever, then that starts to become a problematic story. Next, there's Tempus AI, backed by SoftBank, Baillie Gifford, Google, Novo Holdings. It's a medical data precision AI company. They IPO'd, and they IPO'd at about 39 at the end of the first day, and then they came to a low of 26, so that's a real roller coaster ride for investors, and now they're back up to about 39. So again, I'm glad to see an IPO. I think the story behind this IPO has to do something with SoftBank being behind it. SoftBank does these kinds of things. They'll IPO a company, a big company, in a market where the IPO window is closed. So not sure of any more of a story behind this. It's a little concerning that an AI story in this market pulled in by a third and then came back out and then lifted back up again. So I don't think these two stories mean that the IPO window is open for digital health companies. I think it's always a game. You could easily name 5 or 10 or 20 digital health companies that are spoken of as likely to IPO in the next 12 months or whatever. I don't think any of them is having their board tell their management team to go out and begin an IPO. I don't know if you guys have any thoughts on a trend here.
It looks to me, again, I'm not studying these companies in detail, but it's a little bit more of a roll up, and then Waystar is more of a very mature PE owned company, seeking liquidity for its shareholders. So it doesn't have that venture-y feel, like early stage venture investors growing a company, getting liquidity, and then going on to do wonderful things. But that's part of what we're seeing, I think, in the AI revolution is that maybe this story is about bigger companies more so than small companies. And I was in a boardroom, fellow venture investor. They said, that's my fear, is that this is a large tech company driven phenomenon, unlike in past technology waves, and that as a small investor, small companies, they're gonna have a tougher time competing. I don't share that view, but I think it's an interesting view. And it's interesting that these two companies are massive. They're not small venture-backed companies.
Yeah, you look at the press around the IPO of Microsoft back in the 80s, and tech companies at that time were companies that had valuations of $20 million, for a market cap. And then when I was on Wall Street as a sell-side analyst, 300 million would have been a small market cap for an IPO. And then these companies are IPOing with $1 billion or higher market caps. And so it suggests, well, the IPO is closed right now, but I'd like to see a day when companies can rapidly go from early stage venture investor to later stage venture investor to IPO. So then inflation and interest rates. So we're sort of in a holding pattern right now. The next Fed meeting is July 30th to 31st. What's been slowly happening is that investors are very relieved and happy that the Fed is repeatedly saying they're not going to raise rates further. So the rapid unpredicted rise of rates from 0% risk-free rate to 5 points was caused a lot of kind of anxiety on the part of many investors, venture investors, public investors. And then the Fed has pretty much said they're not raising rates further. But at the start of the year, there was great hope that the Fed would cut rates 3 times at about 25 basis points each by the end of the year. And now we've been seeing the Fed is saying that inflation is still too high, and they'd like to, and Powell has said that interest rates are going to have to stay higher longer to fully combat inflation. And so now we're seeing that Powell readers are saying that he's going to do 0 to 1 rate cuts by the end of the year, not 3 rate cuts by the end of the year. So we might have the rates cut by 25 basis points by the end of the year. And the market would love that. And the market hasn't reacted terribly to this reduction in rate cuts from likely 3 to likely 1 or 0 by the end of the year, as evidenced by indices being high. And so what we really want in the innovation community, we really want both inflation to be beaten and interest rates to come back down. And it looks like we're going to have to wait a little longer. And this is in the context of the investor environment being very tough for 2 years. And we think that if interest rates came down rapidly, the investor environment would get better rapidly. But it could, just because funds have to put money to work as well. But so any thoughts on interest rates and inflation, and will we see the investor environment become? It's been tough for 2 years. Will we see it become more active in the next 2 years? Or call it the next 2 quarters?
Well, I think it's absolutely relevant. It's hard to escape inflation. And, on the flip side, it's hard to deny that 0 interest rates cause a rising tide that floats all boats. I guess when considering different venture capital strategies, notably kind of a distinction between maybe focused on momentum versus value investing, I think we tend to fall more so on the value investing principles. And so we focus our strategy being, I guess, less dependent on outside capital markets to continue to support companies. But, it factors into purchasing powers of customers, industry growth rates, and, even for raising subsequent venture funds or pension funds and endowments and other entities who represent the bedrock of limited partnership investments continue to feel the denominator effect and are overweight into allocations in ventures. So there's this trickle down impact to the entire entrepreneurial community. And in general, I do think that we do see signs of the climate improving in terms of companies that we're seeing and deal flow and, anecdotally, but it's hard to escape it.
Great, thanks. So now we'll move on to the next section of the show, which is industry reports. So in this section, if you saw any reports that matter to you or that you want to call attention to our audience, and by the way, for our live studio audience, feel free in the comments to type in any industry reports, ideally a finding from them, and I'll speak to them in the call. in terms of industry reports, a report that came out recently that I always talk about is the Rock Health report. It came out for the first half of the year, and they cited a number of $5.7 billion deployed across 266 digital health startup raises. And at this rate, they're on track to be better than 2023. So that's great news, up a little bit. And I think Jared, you commented you're seeing that. I think I've been seeing that last 2 months, call it. So they said 34% of deals that they tracked cited AI in the deal. So I think that's higher. I knew that was going on. I think it's higher than I would have expected. And the prevalence of unlabeled fundraisers has started to taper. So when there's an extraordinary measures are taken to get a company funding, they will often suppress the story about the fundraise and also not label the fundraise as well, because it may look out of kilter for the company. And so they're also noting that these unlabeled fundraisers are starting to taper, and we're returning to a more normal environment. I have put out, starting several weeks ago, I began saying that I think that the rate of fundraising is going to, that we've had a tough fundraising environment for 2 years, and the rate of fundraising is going to improve significantly by the fourth quarter. And the number I'm putting out there is by 25%. I think we're going to see a 25% uptick in terms of number of deals by the fourth quarter. If we achieve that, then I think some of this bad pressure that we're under will be over. If we don't appreciate that, then I think that if we don't achieve that, I think we're going to be stuck in the same situation we've been in for 2 years. I'm tracking that, informing my audience how we're tracking against that. And this is good news from the second quarter, first half of the year report from Rock Health is consistent with things getting a little better. So, Todd and Jared, any thoughts on the Rock Health report or other kinds of reports out there?
Yeah, I think as you illustrate, the winds are starting to blow. I think Rock Health tends to be on a little more of the optimistic side. Not a bad thing by any means, and I don't think things are doom and gloom either. I think in addition to the metrics you cited, they called out a significant emphasis on activity in the early stage venture funding. I think they called it early stage energy. And the other thing worth discussing about those non-labeled rounds, ostensibly down rounds or flat rounds, is that they, I think, continue to be prominent. They called out last year's metric of 44% of deals being unlabeled versus 40% this year. They highlighted a quarter by quarter change, but I don't think that's enough time for us to draw substantial conclusions, particularly when we're talking about single digit percentages for preceding years. But I think it's an encouraging sentiment, no doubt. But when I read the Rock Health report again the other day, I contrasted it with a recent article I read in the healthcare blog by Matthew Holt. It was called "Digital Health: There Is No Exit." So you can already tell it's a pretty down look on the industry. And so, as you've discussed in your show many times, the public company valuations in digital health are still down quite a bit, about 50%. And very few companies that IPO'd around the time of COVID have sustained valuations over $1 billion. His report, at least the companies that he was tracking, had only 11 digital health companies worth more than $1 billion or having market caps over $1 billion. And he particularly emphasized, which is to me, an intriguing point, that except for very few examples like Doximity, not many of these companies have been able to achieve durable profitability. I know we discussed a little bit a couple minutes ago, and then another thing that he said, which is pretty pessimistic, is that a lot more of these companies are going under the microscope regarding whether they're ultimately contributing meaningful value to patients. So again, pretty pessimistic. But so I think when you take these two articles together, Rock Health seems to convey early stage momentum, so maybe we'll say a mixed bag for sort of follow-on capital investments. And then the whole article kind of conveys a lack of liquidity or not a whole lot of light at the end of the tunnel. So at Activate, we're trying to minimize our dependence on capital markets as just sort of a general premise. But I can say, having practiced medicine and having used many digital health tools, I generally feel really positive about the digital health industry and not really discouraged by articles like this. I think it just goes to show that there's still sort of mixed sentiment on the climate at large.
Great, thank you. Todd, anything to add?
Yeah, I think both articles, I got it right. We do see a lot of interesting businesses and entrepreneurs right now, and we could not be happier with the level of deal flow, the quality of the deal flow, and some of them are Me Too. Some of the AI automating, the front office of a practice. It gets a little tedious, but there are a bunch where we're getting off the calls feeling, gosh, we should pursue diligence on this business. But I love Matthew, and I like he can be a bit of a downer, but I am have a similar point of view on this topic of exits. It's just been miserable. And the follow-on round market has just been dismal, and everyone's distracted with it. Private equity is not buying a lot of businesses. They're triaging their businesses. These very large, companies have been funded with many, many hundreds of millions of dollars are struggling. Our companies are having difficulty raising capital too. I mean, I don't know what it is like when you have a massive burn rate. It has to be a terrible time for those investors. But our companies, even with their modest burn rates, it's painful. We're having to allocate a much bigger percentage of our funds to supporting our existing companies. And that can't go on forever. So you got to get to cash flow break even.
Great, thanks. And from our audience, Patricia just asked, can I share the links? So in the LinkedIn comments, I just stuck the links to those two articles in there. And then Umberine asks, Jared, can you expand on the question of if the companies are adding value to the consumer? Do you mean adding value to the patient or to the payer economic buyer? And so, do you have any further thoughts on that?
Yeah, I mean, very valid point of clarification. I mean, ultimately, the end beneficiary of all of these companies in healthcare is and should always be patients. And so that was kind of the focus of the discussion is, if again, I have to point out as a cynical article or a pessimistic article, but that was sort of the question is, are patients materially benefiting from all of the funding that's going into digital health? And again, I don't quite share that level of pessimism. I think there's unbelievable benefit to society, to practice of medicine, and to care of patients as a result of digital health. I understand that it's a complex marketplace.
Great, thanks. And there's certainly examples of, there's clinical decision support tool companies that have a true clinical value, but do not have a economic value, and they die on the vine. And then there's revenue cycle management companies that have a true financial return, but no clinical value, don't claim to have any clinical value, and they can be wildly successful, durable businesses. And then there's, I think in the world of employer health, there have been some cases of addressing chronic care conditions, and some people have come along and said, these are tools that it makes sense that patients with chronic conditions could use these tools to improve their care, maybe do it at home or in a lower cost environment, improve their own self-care, etc. But they don't, overall, they're not worth it. They're not care effective. They're not cost effective in that world. That's sorting itself out right now as well. So it's very varied. So the next is trade journal news. So for our audience, you're welcome if you have any stories that you've been reading about in the trades, would like us to comment on. I like to talk about fundraisers if there are any in the last couple of weeks. And so moving on to trade journal news. So first of all, we're still in a distressed time. We're still in a time of more wind downs and businesses exiting markets than we are in fundraisers. So I think I'll start by putting forward my pick as the biggest story in healthcare right now. And I think the biggest story in healthcare is that Walgreens plans to cut its stake in VillageMD. So I remember over the last 10 years when CVS was getting more into primary care and convenience care, and Walmart was getting more into retail clinics, and Walgreens was getting more into convenience care and primary care with VillageMD. Sometimes this is a doctor on site or next door. Other times it's a nurse practitioner. Sometimes it's even a doctor available on telehealth. I thought this was incredibly beneficial to consumers, bad for doctors who have medical school debt, but wonderful for consumers. And I never would have thought that over the course of 10 years, you would see all of them back out of this. And I heard in the Walmart case, there was a fascinating story where, the fact that Walmart has a pharmacy and an optician in the Walmart store lifts purchases of all other goods in the Walmart store. But they were not finding that moving into medical care lifted purchases in the store. So it can be very different reasons why. It's not necessarily because there's some fundamental problem. The business could have been a good primary care practice and just not made sense on a per foot basis because it wasn't contributing to the rest of the store or whatever. So that, I think that's, and I don't know why we're seeing this withdrawal across the board. This is good news for the little doc who has medical school debt, but it's bad news for patient choice. Todd and Jared, any thoughts on any comments on this or your biggest healthcare story of the week?
Well, just one quick comment before Jared shares a longer piece and thesis that we have. One of our CEOs, Kevin Agostine from Kate Health, said that with the Walgreens, CVS, and Walmart exit from retail signifies is that making it easy to buy healthcare services people don't want. It's just not. It's not a question of distribution. It was not a good idea, and it is a remarkable exit across the board, and it is linked to the point Jared is going to make about Medicare Advantage.
Well, as he telegraphed, we do spend a fair amount of time following the news with Medicare Advantage. I mean, it's in a bit of a whirlwind, and it's an area a lot of digital health is exposed to. Suffice it to say that it's being squeezed. Plans are really, I think, near term, and I think these are valid concerns. The current administration is reducing or at least flattening payments to Medicare Advantage, oftentimes in what can seem like non-transparent ways.
It's reducing it 20%.
Yeah, and
I mean, it's major
metrics. Yeah, and so via particularly changes to risk adjustment, and that's kind of what makes Medicare Advantage viable. And so, if you reduce the basis under which an MA plan is paid, then logically those benefits are going to get reduced. So the squeeze on MA plans is just going to push through the system and ultimately squeeze providers and patients. Providers will get paid less. Beneficiaries will have reduced benefits, whether core or supplemental, or negative effects on what amounts to premiums. So. Back in October, CMS stated it's going to recalculate star ratings for plans. And, as a result, seniors basically had this realization that the prospect of fewer supplemental benefits. And, one of the big excitements was, the dental and vision supplements and also higher premiums and particularly effects on Part D and providers experiencing margin compression. So this, I think, serious implications, particularly on our value-based care providers, because arguably the majority or a significant portion of the realization of value-based care has been through Medicare Advantage, and especially in states like Florida or Oregon. So we've started seeing providers push back on MA, and even some large groups walk away from value-based care straight back to fee-for-service. And so in light of that, last month, CMS said it was going to recalculate star ratings after a couple federal rulings declared that essentially they'd erred in calculating original star ratings. And so maybe to some extent, the backlash has been walked back, but a lot of the sentiment's already out of the bag, and people are a little weary. Our former HHS secretary under President Trump was very MA friendly. So if that administration gets a second term, maybe a lot of this could change. But in the meanwhile, there is a pretty pointy article in the Wall Street Journal. I mean, it was pretty scathing. It's called "Insurers Pocketed $50 billion from Medicare for diseases no doctor treated." And the article goes through how insurers and Medicare Advantage program have upcoded to obtain higher payments from the government and ultimately taxpayers. MA was designed to provision healthcare more economically, and some of that debate tends to go down party lines. But the article points out how it's cost taxpayers tens of billions of dollars more, and to some extent, they're blaming the insurers for adding diagnoses to patients that no doctor recorded or substantiated. And some of them were pretty conspicuous, saying that patients had HIV or hepatitis C, and that's pretty conspicuous. And diagnosing rates of diabetic cataracts at far more than is common in Medicare. which already costs Medicare about $700 million over a couple of year span. So, the Medicare Advantage space is somewhere we're following pretty closely, and it's, I think, got some really challenging optics and bumpy waters ahead.
Really interesting, thanks. And so our audience had some questions. So Jason asks, Jared specifically, can you hypothesize why it is so hard for digital health companies to be profitable?
In general, or in what I was just speaking about in Medicare Advantage?
Yeah, well, I think this might have been referring more to what we were covering earlier. And so, Jason, I'll just throw out an observation. I think VCs want to invest in software companies. Software companies have high margins and scale rapidly. I think in digital health, it just costs more to build a product in digital health. The sales cycle is longer. Often there's a big service component mixed in, which means you're going to have you can't have the high margins, the high gross margins of software. Everything is just harder and takes longer in healthcare than it does in B2B and B2C. So those are some structural reasons why I think that you have companies that are 10 years old and still not break even. Waystar, I heard, is cash flow negative, and they're mature enough, and they're in a money making business, revenue cycle management, that they ought to be break even by now. I don't know why they wouldn't be.
That was exactly what I was making earlier. But all that being said, Steve, the tech-enabled services business model, I think, tends to work maybe uniquely well in healthcare, because people working on the front lines of healthcare are just so busy that if you give them another software package to use, it may not get adopted very meaningfully. But if you just do whatever it is for them, that's far more palatable. So I think that's why that model maybe tends to work better in healthcare than many other.
And so let's see. Vinay says United posted 23% reduction in profit. So that's interesting. And then let's see. So I'll move on to some stories here. So American Well, its stock has been trading at less than $1 for more than 30 days. So it has announced a plan to do a 20-to-1 reverse stock split. So I think this is a story of two things. The first is the frothy investor environment of 3 years ago, when a stock like American Well could be lifted to highs, and they sometimes do stock splits when that happens. And then today's risk-off environment, today's doubting, questioning environment takes the stock down to a low level, which is too bad for all of us to have some of the champions of digital health, trading below $1 and doing reverse stock splits. Second is I think the surprising rapid commoditization of the kinds of telehealth that Amwell was offering. So telehealth became a darling during the pandemic. A big infrastructure was built out. You had behavior change with patients, behavior change with providers to use telehealth. And then after that, rapidly, there was both a volume diminishment as people went back to in-person visits, but also a commoditization of this service as well. And then I'll just throw in a couple quick mentions. Also, some very impressive fundraisers of the last couple of weeks, which I think is part of the story of that just recently we've seen the investor environment pick up. And so you have FoodSmart, a personalized telenutrition company. I hadn't heard of this company before, and it's my job to follow these companies. And they, $300 million, a giant fundraise, led by the Rise Fund, which is a part of Texas Pacific Group. Evolutionary Scale raised $142 million to further develop AI models for biological modeling, led by Lux Capital. That sounds like this market that's very hot right now, which is AI modeling of drugs and drug targets. And then virtual obesity care provider Form Health. Evan Richardson, a friend of the show, been on the show as a guest. Congratulations. They raised 38 million Series B, led by Sound Ventures, with followers M13, Signal Fire, and NextView Ventures. So that's interesting. That's also, I would not necessarily call any of those famous digital health venture funds. So this is a story of perhaps Form Health went to the outstanding venture funds who were cautious, and then they wound up raising their round from funds that are not the famous name digital health venture funds. And that's been a big story of the last 2 years. So Todd and Jared, any thoughts on these?
Yeah.
So, and then any other stories from the trades that you guys want to call attention to?
I guess just one that I know you have followed pretty closely before. I saw Tabula Rasa and Exact Care merged to form a new health. We actually had dinner with Brian Adams, the president from Tabula Rasa, a few weeks ago. Echoing sentiments, the PACE markets are strong, and I think that's a pretty strong statement of creating a new health.
Great, thanks. Yeah, and then so Steve in our audience asks some telemedicine thoughts. Are most platforms just aspirational payer businesses, or do they actually offer technology? Can you make money in digital health just doing telemedicine? That's a good complicated thought. Yeah, I would say that I think that there's an opportunity for digital health companies to sort of embrace financial innovation and value-based care and take on risk, so they could they could use their proprietary tech to do a carve out for diabetes care for employers, for example. I think that's a place the market is going, and that's going to be a combination of clinical innovation and technology, and perhaps proprietary technology as well. But I think it's hard for, given the competitive nature of the telehealth market, including the fact that you could literally just do a Zoom call for a primary care visit or a FaceTime call for a primary care visit. I think that's hard to be a business. So, Todd, Jared, any thoughts on Steve's question?
In terms of value add, besides a sort of platform facilitating video chats with a patient, I mean, the video feed that comes through on telehealth plus the audio feed is data substrates. Serves as data substrates that can be used to do interesting things. And so, I've seen examples of writing the note from the visit, meaning the provider has very little of the less fun part of the encounter to do, even coding the visit. And similarly, that same sort of process, I've even seen a company that was using the video feeds from laparoscopic or arthroscopic surgical procedures to write an operative note under the same sort of logic. So, it's, I think, helpful to think about the data that's coming through the encounter as well as just facilitating the interaction.
And a question from Umberine. So how do you look at conversational AI in health? Do you think it's going to be commonplace in the future? Do you think it's too risky to get involved in? How do you think about conversational AI? So I had a guest, Ron Razmi, the cardiologist who studied under Harvard's top AI guy and MIT's top AI guy. And he created a spectrum, which was that which touches human life and that which doesn't touch human life. And he thought that there'd be rapid use of conversational AI and that which doesn't touch human life. So a patient seeking prior authorization, perhaps through conversational AI, and that which does. And he thought that there were too many problems. And let's stick to modern generative AI here. Too many problems still with generative AI to do conversational AI about healthcare. So do you guys have a framework to think about this, or how do you think about conversational AI in healthcare?
I'm bullish on it because I use it a lot. We're going to talk about, our views on consumer health, but our thesis is that patients are going to take charge of their care, and this is one of the principal ways they'll do it. You have to learn how to prompt, you have to learn how to use the services that cite the sources the best. They all have different characteristics. ChatGPT seems to sort of shoot from the hip. Perplexity is sort of better for search and documents the sources better. Microsoft Copilot gets worn out by excessive questioning. It'll just say, move on, like kind of get out of here. Whereas ChatGPT is very tolerant of excessive questioning. So, I think that it's going to be very important. I liked the function health. I want to spend more time looking at what they're doing there. But the idea of querying a service that gets to know you, knows your data, and that provides access to expertise when you need it to resolve questions that are ambiguous sounds good to me. From a consumer point of view, and hopefully from an investor point of view, we have not yet made that investment.
And then Kevin in the audience asks, how can digital health make life better for providers? It's hard to satisfy consumers with burned out providers. So that's a good. I would say we're watching AI potentially address administrative and billing issues, that would be nice to take off the plates of providers. Also, the revolution of the last 10 years has been to take all of the data in healthcare and to put it into the EMR. So in theory, anything a doctor would need to make a decision with is in the EMR. In the past, a doctor might need to go get a manila folder with an X-ray in it and hold the X-ray up to a lit background to make a decision. Now, all of that's delivered through the EMR. And so there's no reason why we can't have algorithmic AI give the doctor answers. And so the idea is that the algorithmic AI knows what the next step is, goes and gathers the data, makes the decision. The doctor gets to that point. The doctor saw a patient, new data comes in from the patient, lab results come in, the doctor looks at it. Everything is done for the doctor, including a recommendation of what to do next. And then the doctor's job is not to memorize 5 medical textbooks and be able to recite it, but to look at everything and understand, how do we practice medicine? What's our rough budget here? Is my patient's an elderly woman and she's very conservative about her care and she doesn't want to put on chemotherapy that will make her feel terrible and have her hair fall out. And so I'm actually going to be more conservative than this decision that's been made for me, because I'm the doctor and I'm responsible for this and I can change it if I need to. And I know the patient, but here's what the standard answer is. And I'll check everything.
I think that's key. I think standard practice in medicine is making decisions in the face of inadequate information or uncertainty. It's just so common. It's every day. And, making judgments is part of the job. I think there's also a lot of, before even touching on the topics of the sort of administrative non-clinical roles of a doctor, there's so many even clinical engagements that doctors are doing that are not leveraging the full scope of their expertise. And so, for example, a radiologist reads all x-rays that I would order in the clinic, even if it's a follow-up x-ray on a patient that's healed their fracture. And they have to comment on the x-ray, write a detailed read as well as an assessment of the radiograph. And that's not really a whole lot of leverage of their true skill, their true knowledge and their experience, because it's basically just reading a normal radiograph. So there are tons of ways AI can just help use doctors for where they're most effective and help offload the tasks that really don't need that level of expertise. And then, of course, how to make doctors happy is every doctor loves taking care of patients. So anything that can help doctors spend less time not taking care of patients is how you make them happy. And, as you mentioned, administrative and billing functions, no doctor really loves sitting in front of an EMR documenting for hours on end. Basically anything that gets a doctor in front of a patient is going to make them happy.
Why should it be any different for a doctor than for us? I want to spend time with entrepreneurs. I want to spend time with my limited partners, doing the back office, the bureaucratic stuff, the administrative stuff. I want automated. And I also want to, leverage, hire one analyst, but have the power of 10. Providers, I think, are going to be very, very similar. They're going to be more productive. They're going to have analytics. They're going to get coding done. They're going to identify care gaps. They're going to input money in their pockets, basically, by more effectively delivering medicine and getting paid for what they deserve. So it sounds like a good match. Although, I don't want to be Pollyannish about it. There have been some really funny things going around recently that have savaged the AI craze and people talking excessively about it. And so it's good to have a healthy skepticism as well. I do recommend everyone take a look at a podcast recently Peter Attia did. He interviewed Isaac Cohane, and it does do a very good job of explaining how AI is applied in medicine and what the history of AI has been. And I'm an Attia devotee. He's got a big ego, but he's not everyone's cup of tea, but I think he's got great expertise.
That's great. Thank you. And if someone from our audience could, in the comments, put a link to that podcast, Peter Attia's podcast,
The Drive
with Zach Cohane. Zach Cohane is Harvard Medical School's top computational medicine and AI in healthcare professor. and he wrote an outstanding book with the head of research at Microsoft on AI and on AI in healthcare. So we're going to skip a couple sections of the show just for time reasons and move on to upcoming conferences. So this is where we do a mini review of conferences that are coming up. And so for our audience, if you could type the names of any conferences you're thinking of going to in July, August, September. And of course, July and August are very slow for conferences. And so for this, I think I will just highlight two. One is Health Tech Con X. So I think we're rapidly running out of good names for healthcare conferences, but this is unifying three different prior conferences, one of which I think is Digital Pharma East and West, I think is now part of Health Tech Con X, and it's in September in Boston. So this is a great one for prescription digital therapeutics and digital medical devices, digital diagnostics in pharma life science. It brings together the product managers at pharma, along with the vendors, along with the investors for that conference. So that's a great one for that community. And then the health conference in October in Las Vegas, I think that's going to continue to be, people don't understand this, but that is an investor conference, not a trade show. And so it's going to continue to be an outstanding investor conference for digital health companies who sell into providers, payers, employers, and who sell enterprise software into pharma life science. So for Jared and Todd, any conferences you want to call out?
We just put cash on the barrel to go to health in force, 3 of us this year, and I'm looking forward to doing it. In addition to Jared, in addition to adding Jared as a partner, we have hired Pierce Crowley, who's a terrific guy. And gosh, I am looking forward to attending founding funders and just all the different events in partnership with folks that can tee up a lot of great meetings in an organized fashion. I have gone for many years to that conference, to JP Morgan as well, to HIMSS, and the more work you do on the front end to meet the companies that really are a match for you, the better it is. So it's not inexpensive, as you know, to send 3 people there. It's an investment. I think they do a good job.
And I'm looking forward to the booth tour.
Say again, sorry?
I'm looking forward to your booth tour.
Oh, thank you. Yeah, I might do a booth tour this year. So a way to think about this, I'll tell some of the strong parts and some of the disappointments of the health conference. So what you should do when it comes to investors and also to other vendor digital health companies, what you should do leading up to this conference is assume they're going, and then write to people you know or people that you aspirationally want to know and say, let's meet at the conference. And most of them will be going. And most of them they're in meeting mode. They're open to meetings. They'll do your meeting because they're there, because it's convenient, because they're trying to fill, 8 meetings a day at a meeting like health would be very productive. And they're trying to fill that for the Monday and Tuesday of health. And so that's one thing to do. The second thing is, if you're affiliated at all with Startup Health or could be affiliated with Startup Health, they do a really good job at the health conference. They run a pitch fest, and they showcase their portfolio companies, and they have a great big booth. And so you could be a pod in the booth of Startup Health at the health conference. And so I would leverage that to the max, or if you're part of some other accelerator, see what they're doing at health and see if they can sponsor you in some way for extra exposure at lower cost at health. What you'll be disappointed by at health is that it's not a trade show, so you don't have product buyers from large incumbents and consolidators walking the aisles, and that's a major liability and drawback. You do have that at HIMSS. You don't have that at JP Morgan. And so what you will have, if you look at the health plans, you want the health plan manager walking the aisles of the booths. Well, it's actually the innovation executive from the health plan, not the health plan manager, general manager. With hospitals, you want the hospital CIO walking the aisles. Well, it's not the hospital CIO walking the aisles at health. It's the hospital innovation executive. And innovation executives are high staff positions with no P&L responsibility and no decision-making authority and no budget. Other than that, though, they're great. And that's the problem with health. And so health is unusual. It's a very unusual conference that's gotten really big. It's actually a food chain of investors where early stage investors are marketing their portfolio companies to later stage investors. But it wants to become a trade show, and it has been unsuccessful so far in becoming a trade show. So that's my overview of health. So then, let's see, the next is someone from our audience has recommended a conference in October. And so I'm going to check out this conference. So what Alex recommends, a must go, the DHAI Summit in Boston. Yes, I've heard about this, Digital Health Artificial Intelligence Summit in Boston. That's worth checking out. Thank you, Alex. It's I think the speakers had a more of an academic orientation, and that's fine because AI is still in its academic phase. And then
the New York City Summit is definitely worth going to. It's the one that kind of primary venture partners puts on, and it is amazing how a significant tech conference in New York City has changed over the years. That the profile, the mix. I would say last year it was a third health. It was great. It was very well done. And that's coming up in October, I believe. Yeah.
So you called that is the New York City Venture Summit sponsored by Primary Ventures?
Yeah, they organize it. I'm not sure it's sponsored. They're really running it, and they're just great connectors. Known the guys there for a long. Well, it's gotten a lot bigger, but I know the founders from a long time ago.
And Umberine in the audience recommends the PCORI conference coming up, I think in October, which is a research conference. It looks like. Great, thank you. So now we're moving on to personal notices. So for my personal notices, I'll mention that, let's see, tomorrow I'm doing a walk of the Esplanade with the innovation community of Health Tech Boston. That's tomorrow, Thursday, in Boston, a fitness walk to be the hero that your activity tracker wants you to be. So if you're in Boston, come out tomorrow after work, 6:00. Then we're going out for drinks afterward. And then August 15th, I'm doing another one of my Boston Health Innovation Nights with Jennifer Joe, an AstraZeneca executive. She's going to talk about, this is in downtown Boston. She's going to talk about how pharma partners with digital health companies. And then Saturday, August 31st, I'm throwing a digital health beach party in Marblehead, Massachusetts. This is meant to be our answer to Burning Man, to show that health nerds have got what it takes. And so drop a note in the comments or email me, and I'm happy to send you the invitations to those events. And Todd and Jared, any personal notices?
Personal notices? Like what?
Or just availabilities or opportunities for people to meet you, or conferences you'll be attending?
Yeah, well, we will be attending those conferences. We will. We're looking for companies that are looking for a partner. They're looking to raise, $2 to $4 million, and we will make ourselves available. And I'm liberal with providing my cell phone, and I'm available by text. And I hook up ad hoc at those conferences, and it kind of comes together at the end. I encourage you to reach out if you think it's a match for what we do, if you're interested in some of our companies as well.
Great, thanks. So now we're moving on to the main topic, which is, are we seeing a new birth of consumerism? So what I guess I'll just open it up to you guys, because you've made investments in consumer digital health companies. And so what made you believe in this sector, and what are you seeing?
Well, I'll first start off with a little bit of a plot twist maybe, but Steve, as you know, like most VCs, we don't focus a lot of our capital on the consumer healthcare business sector, though I think the underpinnings of our current healthcare climate do exercise a sentiment of crisis creates opportunity. In regard to patients acting like consumers, we have made a handful of consumer health investments successfully, and I think we'll be able to point to some valuable takeaways and insights from these endeavors that I think carry over maybe more broadly to digital health. So, it's just, I think it'll be a worthwhile exercise as well.
That's great. Are you able to give us sort of a thesis behind one or more of those digital health investments, and what sort of, just to give us an idea of what you're seeing and what made you want to invest in a consumer digital health company?
I can give you a little bit of the history on what we have done. Would you like are you directing that to Jared? I'm happy to.
Todd, that'd be great if you can give us a summary.
We have invested in a number of them. They've been mostly successful. Map My Fitness was a good business that was really that was run by Robin Thurston, who I spoke to today, who's doing great, who owns Outside Magazine, going on a 50-mile bike ride today with a very famous biker that we all know. And we sold it to Under Armour. It was a great outcome, and it's relevant to what we're going to discuss later. We also backed Rich Rothschild, who I also spoke to today. I basically called all the people I know who are smart in digital health in consumer digital health and have them weigh in on some of these topics. But Mitch Rothschild started Vitals, which we ultimately sold to XLKKR, which owned WebMD. But to give you an example, it's a stark example. That started out as a digital health company providing a physician directory. It was advertising driven. They wanted to pivot into B2B. It did pivot into B2B, but we sold Vitals to WebMD for $20 million. It was a critical infusion of cash into Sapphire Digital, which is what the B2B company became. But basically, Sapphire Digital exited to a Bain-backed entity, Zealous, for, I don't know if I can disclose it, but like 25 times what we sold Vitals for. So, I really, for a while there, the VCs that were doing the consumer deals, that was what you wanted to be. You aspired to do consumer. It seems like, just B2B has become so much more important. We have a really important investment in our current portfolio that is consumer. It's called Crowd Health. And we can talk about it now. I'll maybe just briefly mention it now, but what Andy Schoonover, who is a tremendous, accomplished serial entrepreneur, is doing is he's facilitating those that want to disconnect from our current healthcare system because they are quite dissatisfied with it, or they cannot afford it, the current conventional health insurance. And so what they are doing is they are, for $50 a month, providing access to consumers who would like help finding cash pay doctors who do a good job, but for a lot less. And you get that advocate, you get that coach, you get a much better healthcare experience. But in addition, when you're done with the procedure, you can put that bill to the crowd, and the crowd can pay for it or not. But they tend to pay because the more you pay, the more likely you're going to get your own bills paid. So that is more radical, business. We've invested in many B2B2C businesses over the years, and that's still an important part of the consumer space, which we can talk about. But pure consumer, those are some of the better examples,
Great, thanks. And so also, why don't we define what consumerism is in healthcare? So I'd say a very simple definition is it's consumers being the decision makers and also spending their own money, typically not reimbursed. And so would you agree with that definition, or how could you improve that definition?
Yeah, I'd say in the classic business sense, direct-to-consumer means an enterprise is marketing its offering directly to consumers who make utility and value decisions and then directly transact their dollars for the products or services. So yes, I think we are increasingly seeing that occur in healthcare out of necessity, but I think, that definition kind of meets the spirit of the phenomenon more broadly when, we created initially a decoupling of the purchasing and paying functions of healthcare goods and services. By introducing a third-party payer, we took a lot of agency away from patients in a sense. Healthcare and medicine, clinical medicine is unbelievably complex, no doubt about that. But agency is good for a lot of things. Obviously, navigating healthcare as an engaged participant, empowering patients to take control of our health and engaging with providers, consuming knowledge, spearheading management of chronic conditions, probably, prime example, and navigating cost-effective interventions. So we don't want patients driving blind, of course, but we want them, maybe as I like to say, behaving as like backseat drivers when it comes to their care, and having some degree of authority and accountability over the purchasing power is, I think, undeniably a huge driver of the process. And so when that sentiment bubbles up, that I think really adds a lot of agency back to healthcare. Or to patients in healthcare. And so, I think that can, certainly fit the classic definition of a consumer. But as far as I'm concerned, it can mean consumer discretion over benefit utilization or, discretionary dollars. But really what matters is that consumers are driving their healthcare. And that can be, consumers driving healthcare out of their own wallets or optimizing the spending of their payers. But yes, and in the classic sense, consumerism, paying out of their own wallets.
So there have been a couple of times that we've said that this is the time of the consumer in healthcare. And so, I'm just thinking of, for example, the Fitbit IPO in 2015, when that, and also Castlight, also an IPO from the 2014-15 timeframe, where that was about employers providing a tool to employees to literally say, I'm going to get my scan cheaper by driving 5 miles farther, or I'm going to swap dermatologist to a different doc who gets a better consumer rating, or and so what's new or different this time around, do you think?
I think absolutely right. I mean, high deductible plans were supposed to be this impetus that created a consumer market, but they obviously didn't really materialize. And so I think the evolution of healthcare financing since the 90s, when the third-party payer system really started to evolve, the evolution of our sort of healthcare financing has kind of sought to correct, I think, the disalignment between purchasing and paying. And so there have been multiple attempts or structures to try and re-engage patients as economic consumers, such as with high deductible plans or price transparency tools. But these philosophies of self-rationing through those FSAs or high deductible plans, and third-party rationing through prior authorizations and drug formularies have really relied on the way I think of it as externally imposed kind of top-down approaches to trying to encourage patients to behave like consumers. And they haven't really fully succeeded in engaging patients to act like buyers. And so I think we are starting to see something fundamentally different materialize. And I think there's a developing notion of healthcare consumerism out of necessity. In our current system, having a third-party payer is crucial. It's noble. It's influential, and it helps insulate patients from really high costs of care. And also, the financial worry when they're at their most vulnerable. But I think the dam is finally breaking, and financial pressures are overwhelming the ability of insurers to hold back the sort of flow of financial waters and insulate them. And so I think this shift creates an opportunity for consumer-oriented healthcare technology offerings to compete for these dollars while helping patients navigate these sort of turbulent waters. I mean, I was looking at the latest statistics on medical debt the other day, and Americans in aggregate have medical debt as high as $220 billion, with 88 billion currently in collections. So, to me, what that indicates is patients are being faced with a very unfortunate but very real prospect of having to decide to either forego care or compromise personal finances. And I think people are increasingly saying neither option is tenable. And frankly, it absolutely shouldn't be. And so we shouldn't let that be. And on top of that, navigating the American healthcare system is unbelievably complex and frustrating. Even for me as a physician, navigating the American healthcare system can be unbelievably frustrating. And so I think this creates a great opportunity for innovation and for entrepreneurs. And there are some exciting segments of the consumer market where I think that sentiment is starting to materialize. But, I'd say on a population level or the vast bulk of patients, we haven't realized a panacea by any means. But I want to contrast what I think the old methods of trying to engage consumers really was sort of an externally dictated top-down approach. And now there's a bottoms-up phenomenon where patients are demanding ways to optimize the economics of their healthcare.
That's great. And Todd, did you have anything to add to that?
I have a lot to add. I'm not sure when I should add it, but I'll add something now. So COVID changed everything. And it's personal, on the B2B side, which is where we do most of our investing, we really rely on the entrepreneur to explain the opportunity for their insights. And then as we diligence it, we're using our network, but also their references, and we're getting smart in a hurry. On the consumer side, what's kind of fun about it is that you can, look at your own life, your own journey, and try to apply it. So in COVID, obviously we all got used to telehealth, but I think that many of us got disillusioned with the authority of the government, of the medical associations, a lot of and the advice we were getting from physicians. And there was a lot of experts that were warring with each other that just undermined your confidence. And I think that has prompted me to try to take charge of my own care, and it prompted me to try a lot of things. And I tried a lot of gadgets, a lot of trackers. I mean, we've got a bed that tracks your sleep. I tried heart rate variability. I have many heart rate monitors. I'm almost embarrassed how many I have for swimming, for, optical, electrical, on and on. And I now take a lot of supplements I never took before. I take 3 different types of magnesium, a day, and some curcumin and some vitamin D. So I spend real money on it, and I'm constantly changing that regime. And so, and I mentioned this, taking charge of your health is very important. However, there is something very, very different today than back when MapMyFitness was formed. And that is that the economics of advertising and search have made starting a direct-to-consumer business that relies on advertising very unfavorable. You just cannot get to the top of the heap on a web page as easily as you could before. And if you were not in the app stores early, the penalty is just dramatic. Same thing for podcasters. I have a good friend, Paul Ollinger, who's a podcaster. He said if he had started his podcast in 2015, he would have a much bigger business but he's only started in 2017. So in advertising specifically, the economics are very unfavorable. You cannot use SEM and SEO in a way that really creates lasting value. So the trick now is that you've got to find a very engaged niche where there is loyalty. I believe that Crowd Health has done that. We thought that Crowd Health was going to attract people to save money. It's attracted people because of shared values. They don't like the system. They want to disconnect from it. In the case of there are preternatural drives that are important. Fertility, erectile dysfunction, impedes sex. Those things people are going to pay for. They're going to get to, and they can be embarrassed about it. They want some privacy. And so the company, weight loss is a massive driver. The rich and highly educated that are into longevity, they will spend a fortune. And so, getting to a mass audience is not the trick. You've got to find an engaged niche audience that will pay. And then once you've done that, there are some options. You can add additional products. You can try to add additional niches. Very few are going to cross over to the mainstream and appeal to the mass market. That's much, much tougher. I could go on.
So that's really interesting, talking about the cash pay market in healthcare. And if you today and 10 years ago and 20 years ago, you take an American who's college educated, and what's going to happen, and their goal is to get a high salary job that's going to come with benefits, including paying all or a part of their health plan, and then they are going to get excellent care from that. But there's a lot of people who don't fall into that category, and I've seen, intriguingly, some healthcare companies in America that cater to a Hispanic immigrant audience, and for them, they are all about, effectively, the consumer is guiding a lot of their own care because they may not have a primary care physician who's doing this for them, but it's ways to use discount codes and other methods to get really the low cost care. And it's interesting that the analog of shifting to more of a cash economy in healthcare for Americans who are not immigrants is people who are sick of the system, who are rejecting the system based on shared values.
Yes.
And a side benefit of that is that they might find a doctor who takes cash and then not have to pay for a very expensive health plan, or they might find a discount that gives them a super discount on a drug they need.
I agree with that. You can pay 150% of Medicare instead of 250% if you're in a cash arrangement. That matters. So, while there are the highly engaged, the rich, the highly educated, they're going to adopt various things. The ones just cannot afford health insurance and think it's a terrible value. There are ways to save money, and I think it's going to be a great experiment to figure out a better way to lower cost and to make it a more satisfying experience. Just the drudgery. I sometimes have to block out like a whole Sunday afternoon to just see if all these EOBs and bills I'm getting are real, that shouldn't be. That's a bad use of my time. That is bad for my health. So payer disintermediation is an important theme for us.
So Patricia asks, any idea how we could transition from employer-sponsored plans with effectively no choice or transparency for patients and skyrocketing costs to a marketplace where a patient can get transparency and choice? That's really interesting because it's really hard to break the health insurance block of the employer. Employers choose employees for reasons unrelated to their health, and then they have a group that's stuck together in a powerful way because they're engaged in a profit-making business, and the employer doesn't know the employee's health care cost. And this allows for a natural health insurance block where someone can come in and price insurance across these employees. And it's really that there's no replacement for the employer if you want that sort of insurance. And you're sort of tempting or almost you're getting the employer to cover the costs of the healthy people as well as the unhealthy people. And the healthy people are effectively way overpaying. They might have gotten, if they could say at the start of the year, I'm super young and healthy and I'm not going to consume any healthcare costs, in a totally liquid market, they could get a higher salary for that. But instead, they're not given that option, and employers insure all the employees at the same health plan cost per employee. So it's a good question. Todd, Jared, do you guys have any thoughts on Patricia's idea of how the whole marketplace could break apart and change to one of a marketplace where patients can get transparency and choice?
Well, there are startups that are trying to reinforce the system. They're going to make that more difficult, but for sort of good reasons. The high deductible plan, we were investors in CareGain in 2003. We sold it to Fiserv in 2005, and that was going to enable the traditional insurers to get in the high deductible HSA business, and it was going to have all these tools to help the consumer make these decisions. As Jared said, that didn't really work. Now, you have these high deductibles that people are avoiding care. They also are put in a precarious financial position. So we have seen a business that is providing gap insurance for the health high deductible that is good insurance as opposed to most of the gap plans out there. And so in that case, that solution is going to cement or reinforce the employer-based system. On the other end of the extreme, you can disconnect from the system and go with crowd health. The exchange plans are just not a great value. So I am not optimistic about that. There are some mechanisms, though, that are going to allow you to buy an exchange with payments from the employer. I don't think that that's really what you're asking for, though. I think the government, it would have to be a top-down solution. The government would have to make it very, very difficult. If you remember the Cadillac tax, that was going to make it very difficult for employers, for labor unions to have super rich benefits. But the lobbyists, the entrenched interests push back on that. I don't know if I've got a good idea on how to blow that up, but it should be blown up. I agree with the sentiment. And I would be very open to ideas along those lines.
So I knew a guy, this is now going back 10 years ago, he was super high agency guy, and he figured out for himself that all health plans, he was self-employed, he figured out that all health plans were a ripoff for him. He was a relatively healthy middle-aged guy. So he literally went to multiple doctors in his town and said, can I just pay you cash? Let's figure something out. And some said yes. And so he just saw those doctors and saved a large amount of money. And so in theory, that's available to all of us today. I just think there's a lack of agency, confidence, fears of risk about the future, not understanding what a bad deal it is personally, financially, etc. So in theory, all of us could do that today. But I think those of us who have had a salaried job with benefits mostly paid for, we're uncomfortable.
Yeah, I guess I want to maybe come full circle to that and saying that as a physician, my view is that healthcare consumerism is promising. Having ways that you can chart that out for yourself should be absolutely commended and supported. But medicine's primary goal is always to alleviate human suffering, even in the business arena. And so, insurance is necessary for unexpected events and severe illnesses and things that lead to really expensive, personally ruinous costs, unfortunately. So ensuring patients can focus on recovery without financial worries is important. And so insurance is not always a bad thing. And so I think that's why, rather than these patients go out and just navigate the cash environment themselves, having a crowd or a community to sort of serve as a backstop or to serve as help when things really escalate is an essential tenet of the alternative payment space and sort of that.
We need an alternative network. So MultiPlan and HealthSmart, which is owned by United, I mean, they dominate the networks. They build. So if you can have a company that simply builds a network of cash pay docs, and there have been, MD Saves, there have been a number of entrants in that category, but one that is intelligent about the way they market it to consumers, that could make a big difference, right? I think pairing it with a guide and pairing it with a mechanism to share risk with others that are like you makes a lot of sense. But the idea is right. Employer health insurance is a bad structure.
And we have a bunch of questions, and we also have some more in the show plan. And so, but we're still going to try to end roughly on time. Yeah. So what are some of the technology shocks that are going on that are empowering a new generation, a new birth of consumerism? So if you cycle back, a tech generation ago, it was the cell phone, cloud software, maybe video. But what do you think today are the technological shocks that are driving?
I think a lot of them are sort of the obvious ones that come to mind. Generative AI as sort of an educational source, telehealth as a convenience. It may be over quoted, but I think GLP-1s really are a big nidus for patients discovering that sort of personal agency. Obviously, weight has implications broadly in healthcare. Metabolic syndrome. Even in my world, patients have much higher rates of arthritis or joint pain. And, there's tons of systemic effects just from carrying extra weight. However, it's also a very personal experience and psychologically heavy experience. And so having a drug that can, we'll say conveniently, but more predictably result in weight loss than the alternative, which is more lifestyle modifications that take place over a long period of time and maybe are less certain to have a significant effect. The medication seems like a very, why wouldn't you go down that avenue? And so I think that's sort of a great nidus for patients realizing that they can take control of their health. They can do things that affect positive change on their health status and on their body. And that, I think, trickles over to other areas of their healthcare. They become more engaged. They take a little more oversight into what's going on in the bigger picture of their healthcare.
That's great. And then, so Jason asks, with regard to cash paying consumers, do you see any opportunities in healthcare payment technology in this space, the consumer cash pay space? And I'll just throw out there, so three sort of fun ideas. One is, I don't say fun, but so one would be the provider as the maker of the loan. So we see this when you buy a car from GM, you could get a loan from an S&L, or you could get a loan from GMAC, and you don't have to go to a separate building to get that loan from GMAC. Likewise, if you want to get teeth whitening and you're in the dentist's chair and you want a payment plan or a loan from the dentist, that dentist is in a great position to give you the loan. They might know you and expect you to be able to pay. They might not mind if you don't pay. They'd rather get the business, keep the seat full, because they lose their labor, but the cost of goods sold is very low for them. So that's one idea. Another, I would say, is in the cash pay physician market. How about something like Delta frequent flyer miles? Like the more you stay within this doctor network of cash pay, you collect points, and then you can spend those points on more care, or maybe points also redeem on Amazon for goods or whatever. And that keeps you in that physician network and reduces the pain of your having to make a medical purchase by giving you something notionally on the back end. So those are two sort of cash paying ideas. But Jared, you were going to say something?
No, I mean, patient financing or healthcare financing is an area that I've seen come up a handful of times. And even I guess you could consider it maybe an extension of bundled payments. But I've heard of joint replacement practices offering essentially surgical warranties, extending for some useful life of the patient's operation. I guess with regard to we were talking about crowd health, there has to be some sort of creative financing mechanisms, because it can't function as insurance in the classic sense. So the dollars are actually transacted individual to individual.
A little bit of a bandwidth issue.
There's a thunderstorm. I'm not sure if you can hear it.
You you can make deals. I mean, in terms of financing arrangements, if you're armed with the right information and you know how much competition there is in a market, and you know how much the typical provider is writing off, if you choose to disconnect from the system and you're essentially uninsured, you can negotiate a deal that is much lower, but you can also spread out the payments over a much longer period of time. I mean, that's sort of an interesting idea. If you will create a technology solution that was not solely advocating for the provider's interest, but was arming the consumer with the information and the means to execute a renegotiated deal. We invested in a fintech company a long time ago that would do that. It would look across all of the products that a financial institution would offer to an individual and come up with a payment plan that would deal with auto, mortgage, etc. Perhaps you could do that and make it easy to cut a deal and give leverage to the consumer. But that's essentially what these health shares are doing. And yeah.
And let me bring up just really interesting an opportunity for like a Priceline.com in healthcare. So the nature of Priceline.com was that there's things like hotel rooms that or airline seats where either they are filled with someone who pays, regardless of what they pay, or they are empty and the marginal cost is very low. And so an empty room at the end of the day is a bad deal for a hotel. And similarly, you have seats and beds, you have dental chairs, you have exam rooms in medical practices, and they'd rather have someone in that room so they can leverage their medical license than have that room be empty. And so someone could say, I have a known medical problem, and I would like to pay $75 cash for this. And which of the primary care physicians in the area would like to bid for me to drive to their office instead of the other person's office or whatever? And we're not seeing that, and it's probably because medicine is so complicated and offerings are so different as compared to hotel rooms. But that would be another innovation.
In some ways, that's the underpinnings for how ZocDoc originated, is unfilled appointments. Let's fill them. But I haven't seen anything suggesting sort of negotiated rates on a sort of individualized basis. I guess a medical ethics debate people would probably impose, but it's an interesting idea nonetheless.
So why don't we conclude on, just in our show plan, the next one was about examples of the new birth of consumerism. So any other examples of the new birth of consumerism? And for our audience, I'll throw out there the consumer-oriented pharmacy, which often threw in a prescriber as well as a pharmacy in there. So this is like Hims and Hers and Roman. And they identified that people were really uncomfortable with talking about getting an STD test with their primary care physician, or they were really uncomfortable with talking about their erectile dysfunction with their primary care physician. This is a huge loss for the primary care physician, who literally imagines, I'm there to talk to my patients about this, and I'm not going to tut and disapprove when they say that they have pain and they want a STD test or something like that, or GLP-1s. And so, but these online pharmacies that could also include a prescriber thrown in with the pharmacy online, they found this opportunity where people, even if they had to pay out of pocket, they'd rather do it now than schedule an appointment with a primary care physician and go in for a visit and have to talk to their primary care physician. And they'd rather have it be consumer oriented and fast and pay out of pocket than have it be reimbursed through the regular system. So any other thoughts about examples for our audience of the new birth in consumerism?
I'm going to give you a contradiction instead of an example, if you don't mind. I think that one of the ironies in this, I'm going to attribute this to Paul Ollinger, my buddy who gave me this idea. It's the very innovative apps and companies and devices that are ostensibly enabling better health and more conveniently with technology are often undermining it at the same. And so the idea of Calm as a meditation app having a call to action after a session to post to Instagram, I mean, that is not mindful. That is not helpful, and so that's a loser. There are other examples. I mean, there have been many innovative companies that have offered, made access to mental health, behavioral health therapists easier, and it's important for the right patient. But for those therapists to encourage the recognition of trauma, I'm just not sure that it's helpful. So I encourage people to read Jonathan Haidt's book, and the Anxious Generation, and Abigail Schreier's Bad Therapy. I think we need to not indulge the worst aspects of our devices and our apps, and recognize some of the conflicts of interest in some of the offerings.
Jared, any last thoughts?
Yeah, I think I'll end maybe with an aspiration, and that is, I think the end goal is and should always be true democratization of healthcare data. And we've intended for a long period of time, 10 years now, for health data to be widely accessible and interchangeable. And that still hasn't really occurred in sufficient scope. But, patients serving as the central repository and indexing and aggregation functions of their own healthcare data, that they can then do what was really intended by healthcare transparency and take that information at free will, and engage care, derive actionable insights in real time through something that is continuously evaluating their healthcare data as it comes in. And then also potentially in the future, again, tons of medical ethics that will be raised, but things like drug discovery really require an immense amount of data in today's day and age, or helping identify unique ways to treat certain populations or certain subpopulations of people. And so patients could then have the opportunity to navigate ways to potentially even monetize healthcare data, or potentially engage in things that will help ultimately benefit their own healthcare or people like them in the future. And so I think giving patients the true keys to their healthcare data, and obviously won't work for anyone. Obviously, tons of medical ethics that would need to be figured out, but having patients be sort of the central store and the central clearing room of all of their healthcare data, I think will be truly a game-changing situation for consumer behavior in healthcare.
That's great. Well, thank you both. And I wish I could get to everyone's questions in the chat, but we have to wind down. So Todd and Jared, thank you very much for coming on the show.
Thank you, Steven.
Thanks so much, Steve.
Great work.
And you've been listening to Digital Health Investor Talk. We'll be publishing this show as a podcast on Apple and Spotify. Tune into our next show on Wednesday, July 24th, Reading Disease and Therapy in the Gene Code with Amory Grammer of Ample Biosolutions. And if you're in the Boston area, come to our Digital Health Walk and Talk tomorrow night, Thursday night on the Esplanade. And thanks. Looking forward to seeing you next time. Bye-bye.